All right, good morning, everyone. It is 7:14 on the morning of February 27th, 2023, and this is my pre-market strategy session. Sorry to miss you on Friday. I had a situation that pulled me away from my desk for the first half of Friday, and then I didn't trade the second half of Friday. Here I am, Monday morning, ready to go on a new week. And, I was expecting inflation to come in lighter than expected. Pardon me. And the opposite was true. Let's see if we have last week's. Let's see if market next week. And I think it has last week's. Okay. So let's see. That was Monday. Let's see, Friday is the day that I was expecting. Okay. So expectations, previous month-over-month numbers were negative 0.1%. Expectations were for a 1.4%. This is consumer spending. Expectations were for a 1.4% month-over-month increase, and it came a little bit higher than expected. So 1.8%. Personal income was expected to be 1.2%, and that came in lighter than expected. So that's actually, as far as inflation pressures go, that's kind of forecasting better than expected, actually. PCE index, there was no expectation. Month over month, though, there was a bit of a rise there in PCE. Core PCE, expectations came in a little bit higher than expected here, too. But I mean, a 0.1%, over expectations. Okay, PCE year over year came in, so previously it was 5.3%, came in just a little bit hotter at 5.4%. Year over year core expectations came in about 0.3% higher than expected. New home sales came in 50,000 more than expected. Consumer sentiment came in a little bit higher than expected. So, yeah, there is still a little bit of, inflationary pressure out there. It is, inflation is persistent. Federal Chair Jerome Powell said that when he raises rates, and he expects to raise rates and keep them there for a while. So, I don't think he's going to do what Volcker did, which is just slam rates higher to 18% or something like that, and watch everything crash from there. I think what he's trying to do is raise rates, keep rates high. Let's go into a slowdown. I mean, an economic slowdown in the United States is not a recession, but it will fight inflation. And so suppose for a moment we slow down for a couple of years. That's okay. If GDP... Let's see, where was GDP last? It was recently, let's see, this week, let's go back to last week. I think GDP came in last week. Last week, reports in Fed speak. Let's see, PMIs picked up a little bit. That's good. And if PMIs can pick up more significantly in percentage terms, and it's beating out inflation, that's really good. All right, GDP 2.7% came in a little bit lower than expected at 2.9%, but still, that's growth. It's a bit anemic. Now, I wouldn't even say anemic. It's a bit on the light side, but it's still growth. So I mean, if this continues, if GDP continues to grow, quarter after quarter at this low rate, or even at this rate, that's fine. That's perfectly okay. There's nothing wrong with that. If we start going negative, now there's something else. If GDP starts going negative, things are going to get tough in the normal economy. Now, as far as Wall Street goes, if GDP starts going negative, there'll be probably a little bit of a sell-off on Wall Street on the equity markets, but it probably won't be that bad, really, actually, because if GDP starts going down, that kind of means also that there are a lot of inflationary pressures that are coming down, which means that the Fed is, if not at the top of its rate hiking cycle, then it's really close. So, I mean, you know what? As of right now, everything's okay. There are definitely storm clouds. Definitely storm clouds. The 10-year, 2-year spread, which is only one part of the curve. I mean, there are a ton. Let's go over to, I think it's my large caps and stuff. Yeah, here we go. So here's the, let's see. I wish I could make this bigger. The 3 month, let's see, is just so close behind the 1 year. The 1 year is greater than the 2 year. The 2 year yield is greater than the 5 year yield. The 5 year yield is greater than the 10 year yield. The 10 year yield is greater than the 30 year yield. So almost everything is inverted from top to bottom, aside from the 3 month and the 1 year. Otherwise, the entire rest of the yield curve is inverted. Now, I don't know the duration of the inversions for most of these pairs, except for the 10-2, because really that's the one that I pay any attention to, really. I do also, there was a time when a couple of years ago, prior to the pandemic, where I believe it was the 3 month was yielding higher than the 30 year. And that really caught my eye. I was like, wow. But okay. So here we are. The bond market isn't open yet. It's 7:20 in the morning. You can see. So this is a false reading right here. That the inversion is right now all the way down at 0.884, negative 0.884. But essentially, this is an inversion, and the bond market always gets it right. Right. So here's before the 92 downturn. 92 is a downturn. Here's before the dot-com bubble crash. Here's before the housing bubble crash. And these yield curves were inverted for anywhere between 12 and 18 months. And here we are, I think, let's count the number of months here. So here we are solidly underneath in inverted territory, starting in July of 2022. So 1, 2, 3, 4, 5, 6, 7, 8. We're nearly 8 months in, completely into it, and we're going on 9 months here pretty soon. So that's the first indication of the storm cloud. The other one is that PMIs are below 50. Now, we got a services PMI number last, let's see, when was that? It was last week. Let me get back down to here's last week's. So manufacturing PMI, so services PMI poked its head back above 50.5, which indicates a growing below 50. The Purchase Managers Index is considered contracting, which is a forward indicator for bearish economic conditions. And I think PMI is somewhere around something like 50% of GDP, roughly speaking. Services, not the PMI, but the services industry is something like 50% of the U.S. economy's U.S. GDP. Manufacturing comes in somewhere around 20%, I think, and then government comes in somewhere around 30%. So the 47.8 isn't as weighty as the 50.5. So yeah, it's in contracting territory. It came in better than expected, but it doesn't carry as much weight as a growing services sector. So okay, the contraction and the previous contraction on these numbers are forward indicating, and they are the storm clouds on the horizon. The PMIs plus the yield curve inversion. There is something in our future, and what it is, nobody really knows. But until then, until it's all figured out, things can stay bullish. Here in, the blue lines, these blue vertical lines indicate the date of the the crash, the starting of the crash. And about 2 months prior, certainly in the 2001 and 2008, about 2 months before the yield curve started to normalize again, that's when we saw the top on the market. The same thing in 2008, right up until, so here's where the crash started, this blue line. This was in June 2007. I have it down to the day, actually, on the, if I go to the daily plot. But anyway, right up until, I'd say, roughly November of 2000, that's when we saw the top on the dot-com bubble. Roughly, and I'm speaking very roughly, somewhere around March or April of 2007 is when we saw the top of the housing bubble, and then the crash started, after that. So what's different in this scenario, and no two, I'm not saying it's different this time, but no two scenarios are exactly alike. What's different this time is that we're over a year past the top before the yield curve starts to even normalize again. So there is something else coming our way. There is some other downturn, down leg coming our way, but not until everybody discovers what it is. It's like, oh, it was, who the heck knows? Right now, all the same sort of things that existed, for with respect to overhyped markets, and then a liquidity, which is essentially a liquidity crisis. Over leveraged. A lot of people were over leveraged back here in the dot-com bubble. People were definitely way over leveraged in housing and the housing bubble. And where are things over leveraged right now? Well, I guess, you could kind of call it, government spending. It would be, sovereign debt, as kind of a nation and more of a kind of a global economy. Everything is over leveraged. There are many hundreds of trillions of dollars in debt around the world, wrapped up in everything from social security type of programs to pension programs. Those things aren't just unique to the United States. Those programs exist certainly in Europe and in Japan, just a bit in Australia. The developed economies are over leveraged on their aging population and their government spending. So something is, that's probably where the issue is. It's a sovereign issue. But once, it all kind of clears out, the next new economic cycle will start. So there is pain to come. There is another down leg to come. But I don't think it's until it's right in our faces where it's like, oh, we have to do these massive and holistic we need to make these just enormous and whole economy types of changes to the way we run our lives, essentially. Okay, so that's the big picture. Now let's take a look at the nitty gritty on where the trade is today. Okay, now you can see here I've got two thick yellow dotted lines and two kind of smaller yellow dotted lines here. And what I'm going to do is I'm going to kind of quiet down the rest of these marks, except for this one back here that was from between the 25th of January and the 26th of January. And I remember taking a note of this gap and being like, okay, well, I guess this gap is insignificant at this point, because we definitely rallied away from that. I was bullish. I think it was, I remember I was bullish. I went into a bullish trade right here when we broke above this price on, let's see, the top of the price was put in on Friday, January the 3rd, and I traded to the long side starting on Wednesday the 1st after this momentum move up. I didn't catch it all, but I caught a pretty decent amount of that run up from 291 to 312. Actually, I actually caught a pretty small amount of it and now that I look back at how big the move was, I caught a really small amount of the move up, but nonetheless, move up I did catch. Okay, so going back now, let's take a look at this amazingly small gap that has not been filled yet. Here it is right here. See this tiny little gap right there. It's all of 287.71 or 287.73 to, let me see if I can get this, 288.52. What's that? It's 74 cents. No, 52 plus 27 comes out to 79 cents. That's a 79-cent gap right there. And it hasn't been filled yet. And so here we are. Here's Friday's action. Do we make it all the way back down to this 287? It's possible. It's possible. And Friday's action was about as close to a doji as it gets. So the open was at 291.76 and the close was at 291.85. 9 cents higher. For all intents and purposes, that's a doji candle right there. And usually doji candles indicate a reversal on a daily basis. This just means on a daily basis, a reversal in price action. So a little bit of a move up on today would be, I wouldn't be surprised. In fact, that's the way things are shaping up right now. But then I also wouldn't be surprised to see us drop down to this gap, the bottom of the gap here at 287.73. Maybe even dip a little bit down below it and then come back up again. All right. So also, let me clear these things out of the way. Let me hide these things, right? And so I have a Fibonacci on the retracement of this bear market rally right here that occurred from between Wednesday, the 28th of December, up here to Thursday, the 2nd of February. And the 50% mark, you can see here, this is the 61.8, and 61.8 found support and tried to hold it. You can see a big break up above the 61.8 right there after it came back down and touched it. So, okay, what we're looking at here is the 50% level, which on just for this bear market rally, the 50% level is at 286.89, which is just below that 287.73 bottom of the gap. So, over the next week, if we start trading down and below this gap level and kind of into and below this 50% level and then pop back up above it again, then we are looking at a nice spot to rally. I'm still bullish. I still have a bullish bias. I still think that we are in the middle of a bear market rally that is going to set us up. Let me normalize this again. We're in the middle of a bear market rally that is going to set us up somewhere over the next few months, however long it is, for the next big downturn. And whether that next big downturn gets us back into new lower lows or not, I don't know. Maybe we find support, but I don't know. But what we're doing right now is setting up a bear market rally for the next big leg down once this decides to start to normalize again. With everybody watching this, and I mean everybody on Wall Street, there isn't a trader or a portfolio manager who is not aware of this track record, right? And so a lot of people are expecting a major downturn once this thing starts to normalize again. But Wall Street loves to play its tricks. And so if this yield curve starts to normalize again, and we start to see a downturn, and everybody goes bearish and everything goes nuts and everything, Wall Street will love to find an excuse to take all the bears' money and figure out a way to go long, so that we don't end up with another, enormous crash like what we saw. I'm going to go to the monthly here. After the dot-com bubble. Here's where the dot-com bubble burst right here in late 2000. Dot-com bubble burst and went down, and here's where it bottomed in September of 2002. 2008, right? Here's the bursting of the housing bubble right here. From top to bottom, I believe this was over 50%. Let's go from all the way to the top to the bottom. It's 54.48% downturn. And so everybody is expecting the next big crash, right? After that yield curve normalizes. But a lot of people could be wrong. If things turn out the way I think they're probably going to turn out, which means the downturn after the yield curve inversion, after the yield curve normalizes again, may not be as severe, and it may just be the point where things start to rally again, and we start moving from bottom left to top right again, and it fools a boatload of people who are short. It wouldn't surprise me. This is the most forecast. Most likely the most forecast downturn in history, given the number of people who are now involved in the financial markets, and the number of people who are portfolio managers and financial advisors and so on, that the pressure to the upside will be tremendous, and will keep us out of some kind of financial crisis, crazy financial crisis. Certainly a market reaction to that crazy financial crisis. So for the time being, though, things can definitely be bullish all the way up until the end of when this yield curve starts to normalize again, as history shows. All right, everybody, good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell. I'll see you at tomorrow morning's strategy session. I am out.